So this is Chapter 11, Part 2. We're going to continue on with our discussion of corporations. And at the end of the last video, we were just looking at how to record a transaction involving the issuance of stock. So as we saw, we debited cash for the amount of the proceeds that are to be received, and that's fairly straightforward. And by the way, that debit would be for either cash, or it could also be for the fair market value of any assets that are received. So if in fact the shareholder were to contribute, let's say, equipment with a fair market value of $2,000, then $2,000 would be the debit. So we debit equipment, $2,000, and then credit common stock and paid-in capital in excess of par. So we're always going to use the fair market value of assets. Obviously, cash, the fair market value is the amount of the cash, so there's no issue there. We are not using the cost of the assets. We're using the fair market value at the date the assets are contributed into the business. Okay, so that's very important. The other piece just to make note of is that when we're issuing common stock, we're always using the common stock account at par value. And so from now on, I'm always just going to write common stock at par. Par value, you can read in the book, par was hard to even describe what par means. It was at one time a legal capital or a liquidation capital amount that some states put in place. It was more of a legal requirement, but the accounting followed that. And so from that, and ever since now, the accounting has always drawn a distinction between par value and the additional proceeds and put them into two accounts. So what goes into our common stock account, if you look over to the right, is always going to be the par value, and that's that $10 par value. And that'll always be specified, and you'll always know that. So that's the $1,000. And then the additional amount, whatever's left over, goes into the paid-in capital account in excess of par, and that's where the extra $200 would go. Those are both shareholder equity accounts. They would both go into the paid-in capital account, category. So if we had a balance sheet right now that we prepared, we'd have paid-in capital, and under that heading, we'd have common stock of $1,000, and we'd have paid-in capital in excess of par of $200, for a total paid-in capital amount of $1,200. And then we'd have some amount in retained earnings, and we might even have some amount in treasury stock at some point. Okay, so that's the issuance of common stock. I think it's pretty clear if we look at what is the financial statement effect of the issuance of common stock. And it's pretty clear that in this case, no matter what, assets are going to increase, whether it's cash or some other asset being contributed, and equity is also increasing. So the financial statement effect of issuing common stock or preferred stock or any other class of stock would be to increase assets and to increase equity. So again, just understanding what the effect on the financial statements would be from that transaction. And that makes sense. The owner is putting in additional resources into the company. It makes sense that the company's assets would go up and the corresponding equity would go up. No effect on liabilities. All right, the second type of transaction that we're going to look at, corporate transaction, is the payment of a cash dividend. So there are other types of dividends. There's stock dividends, but we're going to limit our discussion only to cash dividends for the purpose of this course. So a cash dividend is what we've talked about in previous chapters. And again, really that is a withdrawal effectively by the owner. So the business has been making money, and the owners decide that they want to withdraw some of those earnings in the form of dividends. Now, what's required for a cash dividend is, first of all, approval by the board of directors. So the board of directors has to approve the dividend and the amount of the dividend. and of course the dates of the dividend. So that would be, you would notice public companies do that. They do that periodically. The board will agree on and publish their approval or authorization to pay a dividend. The second thing is, because a dividend really is intended to be a return of earnings to its owners or to the shareholders, we must have accumulated earnings to pay dividends. So that's a requirement. So for instance, if a company had never made any money, never had any accumulated earnings, dividends would not be permitted. So in effect, we'd have to have positive retained earnings to be able to pay dividends. Assuming that those two conditions are met, the third condition is really that, obviously in this case we're paying a cash dividend, we would have to have adequate cash to pay the dividend. It would be pretty embarrassing to declare a cash dividend and then not have the cash to pay it. Can't think of that ever having happened before. So anyway, let's just take a look at an example. Let's assume that we've gone ahead and we're going to pay a $1 per share dividend. Just based on the previous example, we have 100 shares outstanding. So there's three particular dates that we have to bear in mind. First is the declaration date. That's the date upon which the board has decided that the company would be bound to the dividend. So on the declaration date, that's the date that establishes the liability. So we are going to record an entry on that date. We're going to debit cash dividends. And again, this entry isn't much different than before. Now, cash dividends is our account. Before we used to just call it dividends, but we'll be more specific. It's cash dividends. And if you remember, cash dividends ends up being closed out to retained earnings. Okay, so as we noted up above, cash dividends is going to be a temporary account. At the end of the year, that gets closed out, and that's going to be a debit or a reduction of retained earnings. And then at this point, we're going to use the new account. It's called dividends payable. And I'm just going to abbreviate this. And again, it's $1 a share times 100 shares. So it's simply $100. So again, on the declaration date, that's the date that establishes the liability. The second date that we need to be concerned about is the record date. The record date is usually about a month after the declaration date. And that's where we establish ownership of the stock. In other words, that's where we determine who owns the stock and then who is going to be entitled to receive the dividend. So if you own the stock on the record date, you are entitled to receive the dividend. So you might own the stock on the declaration date, but you might sell it and then no longer own it. And if that's the case, if you no longer own it on the record date, you do not receive the dividend. So the reason for that time lag is to allow shareholders to position themselves to either receive the dividend or not receive the dividend, depending upon what they choose to do. In this case, this is just really a record-keeping date, and so there's actually no accounting entry here to be made. Now, I should point out that we don't have enough time to discuss it right now, but on the record date, that's when the actual price of the stock will adjust to reflect the fact that people who own the stock on that day will receive the dividend, and the price will adjust accordingly. But that's a discussion for another time. The payment date then is the date on which, and it would again be probably a month after that, would be the date upon which payment occurs. And of course, the dividend is then paid to the owners of the stock on the record date. So anybody who owns the stock on the record date would then get paid the dividend. Now, this used to be about a month in time for purposes of getting everybody's address together so that they could mail checks to the people. Obviously, now this is done mostly electronically. There's probably a few dividend checks that go out, but they still, nonetheless, usually it's about 30 days from the record date. Anyway, so on the payment date, excuse me, so the payment date, what we're going to do is actually pay the dividend. So the entry is pretty straightforward. We're just going to debit dividends payable and credit cash. Assuming we find everybody's address, we know where everybody is, and we pay out the full amount of the dividends for $100. Now, in real life, there may be people who have died or otherwise have relocated or closed their accounts or whatever, and between the record date and the payment date, and it might be difficult to find them, and therefore the $100 that we've declared may not be, in fact, the full amount that's paid out, and we'll come to that in a later chapter. But so for various reasons, we may not be paying out the absolute full $100, but usually it's pretty close. Okay, so those are the, and by the way, I think the one critical thing to note is that the payment of cash dividends, the amount of dividends that we're going to calculate is based upon the shares outstanding. So shares outstanding in the marketplace. And we'll come back to that later. So, what's the financial statement effect of the declaration and payment of a cash dividend? Well, first of all, assets are going to go down. So we're paying out a cash dividend. And of course, ultimately, the cash dividend account gets closed to retained earnings. As a debit, retained earnings will decrease, and therefore equity will decrease. And that makes sense. It's the opposite of the issuance of stock, in which assets go up and equity goes up. Here, what we're doing is paying money out. The owners are withdrawing money, and so therefore assets are going down and equity is going down. So the third corporate transaction that involves equity is called treasury stock. And treasury stock is basically the repurchase of shares by the company. And basically, the reason it's called treasury stock is they put them in the treasury. They put them, let's say, in a vault. Now, treasury stock, the important thing to note here is that treasury stock is accounted for at cost. It is not accounted for at par. So when we're issuing stock, we're accounting for it at par value. But when we're repurchasing stock for the treasury or treasury stock, we're accounting for it at cost. So that's a big, big difference. Now, treasury stock is going to reduce the total number of shares outstanding. So let's say the board of directors initially authorized the potential issue of 1,000 shares over time. That means they had the right to issue those over a period of time. Let's say that they actually issue 100 shares, and we already recorded that transaction earlier. Now, we decide that we're going to go ahead and repurchase 50 shares for the treasury, and we'll go ahead and look at what that entry involves. That would leave us with outstanding shares of 50. So if we had made that dividend payment prior to, which we did prior to these repurchase of treasury shares, we paid the dividend on the 100 shares. That's what was outstanding. If we would have made the dividend payment after this transaction, after the repurchase of the treasury shares, then the dividend payment would have been based on the 50 shares outstanding. So again, dividends are based on outstanding shares. Treasury shares reduce the amount of shares outstanding. So let's just take a look at the entries here. So to repurchase, we're going to use an example. We're going to repurchase 50 shares at $20 a share. So we're going to debit treasury stock, and I'm just going to abbreviate TS. And remember, it's going to be at cost. So cost in this case is 50 shares times $20. And so that's going to give us $1,000. And we're going to finish this up on the next part.